SCHD is up less than 1% in 2025. The S&P 500 is up nearly 18%, and the internet is having an absolute meltdown. I've seen video after video calling SCHD dead money, saying it's time to get out, or that SCHD just sucks. But when I run the numbers, I see three things nobody is talking about. Let's dig into SCHD. Quick overview of how SCHD works. If you already know this cold, skip ahead about 90 seconds. SCHD is the Schwab US Dividend Equity ETF. It has an expense ratio of just 0.06%. It tracks the Dow Jones US Dividend 100 Index. It is a subset of the Dow Jones US Broad Market Index, excluding REITs, master limited partnerships, and preferred stocks and convertibles. The index is designed to measure the performance of high dividend yielding stocks in the US with a record of consistently paying dividends selected for fundamental strength based on financial ratios. So translation, US companies that pay dividends selected for financial strength using quantitative factors. To be eligible for the index, stocks must have at least 10 consecutive years of dividend payments, be above a $500 million market cap, float adjusted, and meet minimum trading liquidity criteria. Then, out of the stocks that are eligible, the index selects the top stocks based on four metrics: cash flow to total debt, return on equity, dividend yield, and 5-year dividend growth rate. Company weighting is based on a modified market capitalization approach. No single stock can exceed 4% of the index. No single sector can exceed 25% of the index. The index rebalances quarterly and reconstitutes itself annually in March. These constraints mean when a company or sector grows faster than the rest of the index, holdings get trimmed to maintain limits. Some people might call this cutting the flowers to water the weeds, and there is some truth to that. But consider this. In other index funds like VOO, a single stock such as NVIDIA alone is 8.5% of the total fund. When one position dominates that heavily, risk increases. By imposing weighting constraints, these risks are curtailed for the SCHD investor. SCHD's approach is probably neutral over time and maybe skews slightly conservative. You won't capture the full upside when one stock goes on a massive run, but you're also not exposed to as much concentration risk. Sometimes you'll benefit from the protection, sometimes you'll miss on the potential gains. It sort of is what it is. Performance. SCHD returns for the last 12 months have been negative. By contrast, VOO is up nearly 15%. That's a significant difference. SCHD has also underperformed across 3 and 5-year time horizons. Annualized returns of 11% over 5 years are not bad, but comparable funds like VIG and DGRO have done considerably better. Lower exposure to technology stocks appears to be one key driver of underperformance over the past 3 years. AI-related tech stocks have had a tremendous bull run, and SCHD hasn't had the same level of exposure. In 2025, another factor emerged. SCHD reconstitutes its portfolio for March. This year, it nearly doubled energy exposure from 12 to 21%, the biggest change made. When you look at SCHD's holdings, energy really means oil and gas exposure, either through production and exploration or equipment and services. Unfortunately for SCHD, the price of oil has declined since March. WTI peaked back in June 2022. Most of the oil and gas stocks SCHD owns are down this year in response. I think this is one of the challenges of SCHD's construction. When you're dealing with a volatile commodity like oil, backward-looking financial metrics aren't necessarily great indicators of forward stock prices. Oil and gas stocks are so sensitive to oil prices that a low PE or a low price to cash flow metric using trailing financial metrics might not indicate value. It might be forecasting lower business profits due to declining oil prices. The one energy standout in the portfolio is Valero. Valero is in the refining business. The refining business, which uses crude oil as an input, is more concerned with the spread between crude oil and refined products like gasoline. In the industry, this is known as the crack spread. Profits for refiners can counterintuitively increase in a declining crude oil market because the input costs, crude oil, can fall faster than the price of finished products. If you've ever heard on the news that the price of oil is down, but then you go to the gas station and see almost no difference at the pump, you've experienced the crack spread. That didn't sound right, but I'm going to keep it. Distribution sustainability. This table shows the sources of returns over the last 2 years and compares them to distributions paid to shareholders. There's no point in investing in a dividend ETF if the dividends get cut. SCHD does not distribute more in dividends than it collects from underlying companies. For For 2025, SCHD collected approximately $2.5 billion in dividends and paid about $2.47 billion in distributions. Similarly, in 2024, dividends and distributions were aligned. For you as an investor, this is important. It shows prudent financial management. When distributions are simply a pass-through of collected dividends, the risk of distribution cuts is lowered. However, when distributions to shareholders exceed collected dividends and rely on share price appreciation to fund payouts, risk can increase. Check out our latest video on QQQI if you want to see a contrast. Let me walk you through this table first and then we'll discuss it. These are the top 13 companies in SCHD by weight. It represents about 50% of total assets in the portfolio. I've listed some key financial information including revenue, sales, net income, which is profit, operating cash flow, capital expenditures or CapEx for short, free cash flow noted here as FCF, free cash flow is operating cash flow minus CapEx, dividends paid in cash, excluding dividend reinvestment programs or DRIP programs, and the payout ratio, which is dividends divided by free cash flow. A couple other notes about this table. This information covers year-to-date 2025. Cisco Systems has a July year-end, so I had to do a little bit of math to align the figures for Cisco with the other companies. Second, Coca-Cola and Pepsi seem to have very high payout ratios, but context matters here. First, Coca-Cola got hit with a $6 billion tax liability payment. This affects cash flow, but not on an ongoing basis. Next, both of these companies are consumer products businesses, which have to invest more heavily in things like inventory going into the holiday season, which reduces cash flow temporarily in the period we're considering, because we're only in Q3. If you look at Coke and Pepsi's payout ratios on an annual basis, excluding unusual items, they're fairly reasonable. Okay, now look at the grand total. As an SCHD investor, this is what you own. You get a slice of all this money. Don't lose sight of that fact. Two key points here. Number one, dividends appear well supported based on underlying financials of the companies. As well, you can see from this table, not only do the underlying companies have strong dividend coverage, but as we discussed, SCHD at the fund level does not distribute more than it takes in as dividends. So this is very responsible and conservative from a financial management perspective. So while SCHD might be paying only around 3.8% in dividend yield, that yield appears secure. Number two, don't forget what else you own. Look, I know income investors think almost exclusively in terms of distribution and yield. It's as if nothing else matters. But check out the operating cash flow. That's about $160 billion. Keep in mind, this is only about half of SCHD's holdings. That $160 billion you own a proportional piece of, not just the portion paid out to you in cash as a distribution. See the $49 billion in CapEx? These companies are investing in their businesses. They're buying more equipment, they're expanding production, they're creating new products. These investments are going to maintain existing cash flow and to grow cash flow. And that $111 billion in free cash flow, that's yours as an owner. It doesn't all get paid out to you in cash, but it's retained inside the companies for use to pay down debt, save for later, whatever. The point is that you, as an owner, still earned that money. This is what pushes share prices up over time. And it's completely overlooked when people only focus on dividend yield or temporary changes in share price in a given year, for example. And as you'll see in the next session, this is probably one of the most overlooked features of SCHD, because here's where it gets really interesting. Let me address something first. People call SCHD a, quote, value fund, as if that explains underperformance. But terms like value and growth, they're marketing labels. They miss the point for investment decision making. Think about it. Which value investor doesn't want the companies they own to grow? Which growth investor doesn't want to buy a company at a lower price? See what I'm saying? It's nonsense. Valuation is valuation regardless of the label. So now take a look at this table. This is comparing SCHD to VIG, which is the Vanguard Dividend Appreciation ETF, and DGRO, iShares Core Dividend Growth ETF. These are funds people frequently compare to SCHD. With the exception of the earnings yield, which is just the inverse of the PE multiple, these metrics come from the respective fund websites, so you can check them out. It's a little unclear exactly how each fund is calculating these metrics, but for the sake of argument, let's assume they're generally comparable, if perhaps not perfectly. What is clear is that SCHD is by far the cheapest of the three. meaning that you as an investor are able to buy more in terms of earnings, cash flow, and assets per dollar you have to invest. Do you see that? If you invest $1 into SCHD, you're getting a 6% earnings yield. A portion of that gets paid out to you in dividends, whereas VIG and DGRO are getting around 4%. Crucially, SCHD's cash flow yield is about 11%. This means if you invest $100,000 into SCHD and somehow you had access to all the cash flow, not just dividends, you could theoretically collect $11,000 per year. Recall the previous section we just discussed. Despite not having access to all that cash flow, it is working on your behalf as an investor in SCHD's portfolio companies. That cash flow gets invested, saved, used to create new products, and some of it gets paid out to you. If you compare that 11% to investments like US Treasuries, the difference is stark because 10-year Treasuries currently yield about 4% right now. That 7% differential is working on your behalf, whether paid out in dividends or not, and compounds over time. It's one of the principal reasons why equities can outperform. I think you can argue that today, SCHD is a better deal relative to competing funds. But what about in absolute terms? Is it a good deal on its own? This chart here is a historical PE ratio chart for the S&P 500. You can see that right now the PE is about 31 times, meaning you're paying $31 for every $1 in current earnings. Important caveat here, we're comparing two different things, the S&P 500 index and SCHD, which is based on the Dow Jones Dividend 100 Index. I'm using the S&P 500 because it's the more popular benchmark and I think it has better historical data. But anyway, in any event, it's fine because these are still real investment alternatives for investors to consider. Now, the historical average is 16 times for the S&P 500. That's almost exactly where SCHD is trading right now. So why 16 times? Is this some magical number? No, remember, it's a stock market. What a historical average of 16 times indicates is that investors collectively are willing to pay, on average, about $16 for every $1 of current earnings. This translates into a roughly 6% current earnings yield. Given these comparisons, I think it wouldn't be wrong to say that SCHD appears like a better bargain on a relative basis and probably approximates fair value on an absolute basis compared to historical market averages. Does that mean the price can't go lower? Of course not. Business profits can also go down. Equities always have inherent business risk, so prices can drop. Just as stocks can go from fair valued to overvalued, they can also go from fair value to undervalued. But standing here today, if you as an investor have a portion of your money you're looking to allocate to equities, investors generally benefit from considering valuation. From that perspective, SCHD at least looks reasonably priced in the context of alternatives and overall market valuation levels. It might even be compelling depending on your situation as an investor, but I'll leave that for you to decide. Remember the panic at the start of this video? What do you think is creating this opportunity from a valuation standpoint? So in conclusion, is the bottom line argument it's the valuation stupid? Yeah, kinda. Valuation creates opportunity. A quote from a famous portfolio manager, Howard Marks, goes like this: investment success doesn't come from buying good things, but from buying things well. You can buy a terrible company or a terrible fund at an unbelievable price and make money. You can buy an amazing company at too high a price and lose money. Nothing's worth an infinite amount of money. The same is true for ETFs and funds. Right now, it appears SCHD is letting you buy a group of quality companies at reasonable prices while everyone else is sort of panicking about it. On top of the valuation argument, SCHD also has a good historical track record which, while not indicative of future performance, it is important to see. The fund appears to be managed soundly from a financial perspective, as we already talked about. Is it a boring fund? Yeah, it is. Super boring, actually. Owning a group of businesses that sells gasoline, pharmaceuticals, soft drinks, it's not exciting. But regular people buy these products, and these businesses make a lot of money for shareholders. Isn't that the point? If you find this kind of straightforward financial analysis useful, please hit subscribe. I break down ETFs and other financial products. If you want me to analyze something specific, drop me a comment. Tell me what you would like me to look at, and I'll do it for you. I read every comment. Hi, I'm Charles. I don't like most investing and finance content online. It tends to try to sell you something. You don't need to buy anything from me. This content is for educational purposes only. Seek professional advice for your situation. I want to make financial freedom as accessible to the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.